Hi guys, welcome back. This is gonna be the video summary of Thanks God It's Friday setup from ICT, from the ICT Mentorship 2023 and the ICT strategies. The Thank God It's Friday is a day-specific model from the ICT Mentorship 2023 and appears only on Fridays. And so, what is the setup and the process for using the Thank God It's Friday from ICT? Number one, we need to understand the price movement on a higher time frame, for example, the 1 month time frame. Number two, we need to understand PD arrays. Number three, we need to analyze the weekly move of the market and understand the strength of the candles. Number four, we need to apply the power of three to the weekly moves of the price. Number five, we need to wait for the price to form the high or the low of that week on Fridays, and that usually happens between 12 and 2 p.m. New York local time. Number six, we need to apply the Fibonacci and find our target range, which is going to be between 20 and 30%. Number seven, we need to apply our ICT model and the confluences in order to enter the trade. And when we enter the trade right away, we are also going to set up our stop loss and our take profits. And last, we need to take the profits and start enjoying our weekend. The Thank God It's Friday setup actually is characterized by price retracing back into the weekly opening gap, but also the weekly power of three will play a role in this setup. So let's look at an example. Let's start by looking at the Nasdaq and at the mid-June 2023. Here we can see the Nasdaq 100 E-mini futures on the 1 month time frame. We notice right away that there is a CB or a fair value gap and that the price has retraced back into it. Looking at the 1 week time frame, we can see that premium fair value gap a little bit bigger and the price movements a little bit more precisely. I receive very often the question of why do I need to start my analysis, my forecast from the 1 month time frame? Why can I not just start from the weekly time frame? And here you have the exact example. If you notice and you look very closely, we do not see the fair value gap, the big fair value gap on the weekly time frame. We see it only on the 1 month time frame, and that's the reason why it's so important to always start your analysis on the monthly time frame, because you're going to notice and see things that you actually do not see on other time frames. ICT tells us that the Nasdaq has been the leader compared to other indexes in rising higher in the past weeks. What happens after the price forms a fair value gap and then taps back into it by respecting it? Well, usually the price starts falling down, starts going away from that fair value gap that just tapped back into. And I just want to highlight it here and zoom in a second, guys. Look at the precision. The precision with which the price taps back into that fair value gap and then still keeps respecting it on a 1 week time frame is really impressive. What we are going to do now is to focus on this area here. Let's observe the wicks and the opening and the close of these candles. What do we notice when we look at it very carefully? We notice mainly two things. All of these candles are bullish candles, and so they close higher than the opening price. But also we can clearly see that the close of each one of these candles is above the midpoint of the entire range. And so the close is near each candle's high. Let me give you an example, and let's take this candle here. This candle here opens where you see there down below, and it actually closes on top there. So I put two arrows and I show you the wall movement of that specific candle, or better, the movement of the body of that specific candle. But now let's really zoom in even closely and let's observe it better. When we zoom in, we can see that this is a bullish candle that first opened around 1.3800, then it starts going higher, and then it closes around 143,144. What we want to notice is where this candle closes. So we're looking at the actual candle, we're not looking at the wick. And we can see that the point where this candle closes is actually above the next candle's wick. And so the next candle's weeks consequent encroachment. So let me explain it again with my own words. The candle that we are looking at, that still has that big black arrow pointing at it, let's look at that candle. Where that candle opens and where that candle closes. You see here I highlighted the close of the candle and the open of the candle. Let's look at the candle that opens after the candle that we were observing. So it's the candle that's here highlighted with that orange arrow. That candle has a wick that goes lower and actually touches the previous movements of the candle that we were looking at. And so the candle with the black arrow. The wick of the candle that's highlighted in orange has a consequent encroachment, or better, the midpoint of that wick, which I highlighted here with an orange line. We can see that these candles are so bullish that the close of the candle, of the black candle with the black arrow that we've seen before, is actually above the consequent encroachments wick of the following candle. And so, highlighting the consequent encroachment of the wick of the following candle, we can see that the previous candle, the one that we have highlighted with the black arrow, is actually going above that level. Let's go to the next candle. What do we observe here? If we take that candle, we can see where it opens and where it closes, and we can see also its wick. So this is another bullish candle. The point where this candle closes, so the actual candle, not the wick, is above the next candle's body open. Let me highlight it and zoom in even more so that you can see it with more precision. The point where this candle that we have here with the black arrow actually closes is above the next candle body open. And so the wicks, what they are showing is that they are very, very bullish. Now, let's take a deep breath in, leave this concept on a side, let it settle in our minds, and step aside for a moment. Let's go back to something that we have seen already in the past, and something that we need to keep in mind for today's episode, which is indeed the power of three. Let's refresh our knowledge about it. Looking at the power of three, we can notice the movements. Number one, we're going to have the open of the candle. Number two, we're going to see the price going lower. Number three, we're going to see the price or the candle rallying higher. Number four, we're going to see the price forming a high. And number five, we're going to see the price closing lower than the point number four. Remember that the power of three can be based on several different time frames. Here, we will use the power of three in reference to the weekly time frame. So we expect to see these price movements forming and showing on a 1 week time frame. How can we use the power of three to our advantage? Well, we need to understand where we would like to enter the trade and how we can make the most amount of money and the most amount of profit from it. And so usually we are interested in this area as it can allow us to enter in the market before it rallies higher, for example. And so what should we be looking for in this area there between number one and number two? Usually what we should be looking for in this area then are fair value gaps, sell stops on a lower time frame, price trading down on an old high, and in general something that will promote some level of discount for the price so that we can enter there and then rally higher. Let me show you now the power of three on a concrete example in the markets. So here we are on the Nasdaq 100 E-mini futures on the 1 week time frame, and we have actually zoomed. On the left side, I put a little square with the power of three as we have seen it before. Keep in mind that the power of three represents every single bullish candle, right? So power of three, when it's bullish, as in our example, every single candle is going to have this type of movement. But it's also true that we can see that movement within the price on, for example, a 1 day or a 1 week time frame. And so in the example that we have seen before, each single candle here in that price movement would represent a bullish power of three. Now let's focus on this candle or on this price range. You can see here that we have 3 orange arrows around that candle that I wanted to focus on, so that we are 1000% sure that we are looking at the same thing. And so we're looking at the candle that is actually entered inside the fair value gap. This range is really interesting for us, as we have our 2 red lines showing us the fair value gap on the monthly. If we were to take the fair value gap off the chart, we would actually see nothing. It would just look like a bullish candle going higher. And so let's do that. Look at that. If we do not look at the 1 month time frame and simply look at the price movements on the 1 week time frame, we're actually losing a lot of information. And that candle, as special as it was before, is now actually just another bullish candle. But when we put the fair value gap and we look at the 1 month time frame, we see something like that, and it's much, much more interesting. Remember, guys, spend a lot of time studying higher time frames, for example, the 1 month or the 1 week. The market will always gravitate towards higher time frames, towards their premium and discount arrays. Remember that when the price goes towards a premium array, our bias is mainly bullish. When the price goes towards a discount array, our bias is mainly bearish. And so let's go back to the Nasdaq 100 E-mini futures on the 1 week time frame, and let's zoom in and then let's look at this candle that we highlighted before. Looking at that candle, we can see that the price is actually displaying the power of 3 perfectly. And here I put again the square with the power of 3, the bullish power of 3 that you can observe here. Let's recreate the price movements of the power of 3. Number 1, we have the opening. Number 2, we have the price going a little bit lower, which in this case happened without us actually noticing it on the candle of the 1 week. Then the price rallies higher, and we can see that it's really a big movement. Number 4, the price with the week forms the high, the weekly high, but it also goes and touches almost the higher part of the fair value gap on the 1 month time frame. And number 5, the price closes lower than the highest point of that week. And so the price, instead of closing on the price level point number 4, the price comes lower and closes on point number 5. What we can anticipate on a weekly time frame after we see that this candle is bullish and we have a bullish power of 3 is that the price will be retracing back or closing lower than the weekly high. So our weekly high is number 4, and so what we can anticipate is that the price is going to come from number 4 to number 5, and we can anticipate it with a high degree of certainty, which is something that we like to do as ICT traders, and to take those trades where we know we're going to be making a lot of profit. I want to repeat it again. We can anticipate the price forming point number 5 if it did not form it earlier that week. So let's go back a moment to the power of 3. We have here again the movements of the power of 3. ICT tells us that what we can anticipate on a weekly time frame after we see that this candle is bullish and we have a bullish power of 3 is the price retracing back or closing lower than the weekly high. We can anticipate the price forming point number 5 on Friday specifically if the market has reached some kind of premium array. Then it could continue going higher. So something that we need to pay attention to is that where is the market? Where is the price in the market in that moment? If the market has reached some kind of premium array, then it could continue going higher. So we really need to pay attention to that. Keeping that in mind, the Thank God It's Friday setup, it's actually a retracement setup and is more likely to form on a Friday afternoon. But it could also be forming on a Friday morning sometimes, so we need to keep that in mind. Going back on our example, if we want to know until where the price would be retracing to, and so what is our target, we can actually use the Fibonacci. Because as we have seen before, guys, we know the high of that week and the high of that candle, what we need to know is how low at that day the price gonna actually retrace back to, so that we know until where and until when we should be holding our price target. So if we want to use Fibonacci, we're going to start from here, which is our weekly range high, and we are going to anchor it until our weekly range low, and so until there. We're going to assign the levels of 0.20 and 0.30, or 20% and 30% on our Fibonacci settings, and you will find them also shown here on the chart. ICT highlighted them for us with those red lines with a 20% and 30%. What ICT is telling us is that the price is most likely to retrace and close on a Friday afternoon at 4 p.m. New York local time between the 20 and the 30% level of our Fibonacci. And so this is where the price is most likely to retrace to and to close between 20 and 30%. If we want to know until where the price would be retracing to, and so our target, we can use the Fibonacci retracement tool. Those are going to be our 20% and our 30% levels to which the price is most likely to retrace to and to close. We anchor the Fib at the low of that week and at the high of that week. But how do we find the high of that week? How do we actually know that the price has reached its highest point? Well, usually it forms on Friday between 12 and 2 p.m. New York local time. So we wait until then to have our high of the week. And after that, we know where the price will be retracing to. Something that ICT shows us and tells us is that the price coming back down and coming back lower on Fridays when it was higher, when it actually went higher during that week, and so when it had a bullish movement, can be classified, and we can think about it as a weekly retracement or an intraday reversal. When the price, and this is very important, retraces 40% or more, that could signify a reversal for the upcoming week. So remember that, guys. On Sundays, you can do your analysis of the previous week, and when you see that the last weekly candle was extremely bullish, but the price has retraced more than 40%, that could signify that the upcoming week, the week that's about to start, will show us a reversal. Okay, let's go now to the Nasdaq 100 mini futures and let's look at the 1-day time frame. We still keep our notes from the 1 month and the 1 week time frame, so we can see here the weekly high, the 20% weekly range and the 30% weekly range, and also the weekly low. And so if we can assign to each candle, because this is a 1-day time frame, so each candle is worth 1 day of price movement, we can see the Monday, the Tuesday, the Wednesday, the Thursday, and the Friday candles. We can observe that Friday, the Friday candle, is retracing precisely back into the 20 to 30% range. And we can also see that the high of that week was actually formed on Friday. Now, let's look at the 1-hour time frame and let's observe the price movements. What can we actually observe here? If you want, you can pause the video for a moment and observe the price movements on your own. So ICT shows us here in pink the Friday movement. He also tells us that where the gray start, it's actually the following week, the 19th of June, and we can ignore that because it's already the movements of the following week, so we can just forget about it for a moment. Let's focus on Friday. The high of that week was formed on Friday around the 12 p.m. lunchtime. After that, the price retraced back into the 20 to 30% range, and it has actually closed there. ICT highlighted in orange the weekly range on a 1-hour time frame so that we can really focus on those price movements. If we zoom on the high end of this range, here goes the zoom, and we are now on the 15 minutes time frame so that we can observe the movements better. So remember, everything in orange regards the weekly range and the weekly price movements of that week from Monday until Friday. I'm going to cover now part of the chart so that we can focus one at a time on the price movements. So the high of that week formed around 9 a.m. on Friday. It rallies up, creating a Judas swing. When the price creates a Judas swing, that means that everyone will think that the price will keep going higher still. But that's not going to be us. We know that we are expecting the price to come lower. Also, the price broke buy-side liquidity by going higher. And that's very interesting for us. If I uncover what happens after, this is what you're going to see. Let's observe the price movement. And let's also take a look at the time of the day. After the price forms that high, we have displacement and the price is going lower and it's forming an ICT order block, which we can see here with the OB order block and the white line. The change in the state of delivery is made when the price breaks below this bullish candle and starts going lower. That's the moment in which we have the change in the state of delivery. Then the price, by going lower, takes a short-term low, which we can see here with the red circle. Then the price, after going lower, actually forms a new high, which you can also see here with that red circle. And then the price forms a new high. And with the high that the price has formed before, it actually has formed for us a fair value gap. But then after the fair value gap, the price retraces back into it and forms another new high. And so here we actually have a fair value gap or a CB, a sell-side imbalance, a buy-side inefficiency. When we have a fair value gap and we have this price movement, what we can see very clearly is the ICT Mentorship 2022 entry model. And so following the ICT Mentorship 2022 entry model, what we would like to do is to enter inside the fair value gap when the price actually retraces back into it. The price re-enters back inside this fair value gap 3 times and it keeps going up and down, up and down. But why, guys? This doesn't happen all the time, so when it happens, it's good to ask ourselves, why is the price doing that? To answer that question, and to answer any question that we have that regards why is the price doing something, we should always look at the time of the day. And if we look at the time of the day, when the price is re-entering back into this fair value gap, we can see that it's actually lunchtime. Notice here these 2 arrows pointing to these 2 highs. This price creates these super small hiccups, but we could expect that. And we could expect that because it's lunchtime. And after that, the price actually starts going lower and lower, and it ends the week inside the 20 to 30% Fibonacci, which we see here with the 2 red lines. Let's switch and let's go back now to a lower time frame. So from the 50 minutes time frame, let's go to the 5 minutes time frame. What we can see is just precisely the classic ICT Mentorship 2022 entry model. We can see here the fair value gap. We can see the weekly high and the 2 red lines that regard the 20% weekly range and the 30% weekly range. We already know that the price keeps painting, keeps showing us the same patterns of every single different time frame. And that also means that we can see here a break of a low, a fair value gap, and the price tracing back into it and then going lower again. So it's a fair value gap inside a fair value gap. In bright yellow, the fair value gap on the 15 minutes time frame, and on pink, the fair value gap on the 5 minutes time frame. Specifically from 12 p.m. New York lunchtime, we can see a low, a high, a higher high, a fair value gap, and a break of low. ICT highlights us here to remember one thing, that students from different ICT material and from different ICT mentorships, such as the Mentorship 22, Mentorship 23, or even the core content, are going to see and notice different concepts within the same move. That's actually amazing because different concepts, different material, different content from ICT and different strategies are still going to make us want to take the same trades with just using different tools. Here we have a rejection block. And so we first find the highest down close candle inside the fair value gap, and we then consider the highest part of its body. Rejection blocks have the same function as running out liquidity. And so by following this process, we're going to have this red line. If the wicks paint out of the lines a little bit, we do not panic. Our model is still respected. If it's only the wicks and if it's only a little bit, then it's fine. If it would be the body of a candle and if it would be a big movement, then we should get worried and start thinking, wait, are we doing the right thing? Is it the right trade? Okay, let's go back to observe the price movements. Looking at the price movements here, we can see that the price is actually giving us so many possibilities to enter this trade, even after the price exits the fair value gap to go lower. So where would you then enter the trade? If you knew that the price is going lower, it's going to retrace between the 20% and the 30% of the weekly range, and it's going to somehow end up there. Where would you enter? So just to remind you, our ideal trade would be this one. This would be in blue our entry trade area, so the area in which we would like to enter the trade. More specifically, we would enter either when the price retraces back on the yellow area, which is the 15 minutes fair value gap, or in the pink area where the price has formed a fair value gap on the 5 minutes time frame. Anyhow, the blue area is our ideal entry area for our trade. We would then place our stop loss in the area right above or at the fair value gap on the 50 minutes time frame, and we would target our profits in the green area highlighted here. Specifically, we know that the price would target the area between the 20 and the 30% weekly range of the Fibonacci. And so our first profit target could be actually this black line that I pointed here. And our second profit target can actually be closer to the 30% weekly range. Okay guys, and these are kind of like my thoughts about our perfect entry into this trade. What ICT says is actually this. Then let's go back to the bear chart and look at what he tells us. He goes on the 1 minute time frame. And here we can see the fair value gaps on the 15 minutes time frame, which is the one in yellow, the fair value gap, the bigger one, the first one in pink, which is on the 5 minutes time frame, and also a third fair value gap, which is on the 1 minute time frame. And so we can specifically see here now on the 1 minute time frame the fair value gap on the 5 minutes and the fair value gap on the 1 minute time frame. The second fair value gap actually occurs around and after 2 p.m. New York local time. What do we know and what we should remember is that on index futures, such as the Nasdaq, from 2 p.m. to 3 p.m., we actually can use the ICT silver bullet strategy. So for this Thank God It's Friday strategy, we can actually use the silver bullet entry. I highlighted here in red with a box the price movements that are interesting for us for the silver bullet entry. Guys, just a quick parenthesis, check out my video and the summary on the ICT silver bullet. If you have a fair value gap that occurs and price movements that occur right before the right time for you to enter the silver bullet, that should also still be taken into consideration and you can still enter in that trade. I mean, look at it here. So this fair value gap would be our silver bullet trade entry. But we also have another silver bullet trade entry, which you can see here with that fair value gap highlighted in green. And so looking at the Thank God It's Friday strategy and looking from 2 p.m. until 3 p.m. New York local time, we would have two other possibilities to enter the trade, respecting the silver bullet times. It's not too late, even if the price is actually getting quite close to the red line, our Fibonacci target, our Fibonacci first target, the 20%. It's not too late. Why? We trust the strategies, we trust the silver bullet trade entry. If we actually entered on the second fair value gap using the silver bullet strategy, where should we place our target profit? I'm going to remind you always, guys, if you're in doubt, if you have a good question and you don't know where to start with finding the answer, always look at the time of the day. And ICT tells us that we would actually exit our trade around 4 p.m., around or right before 4 p.m. New York local time. And so let me zoom in, guys, for us. Zooming in on the 1 minute time frame, this is the price structure that we are going to see and that we are going to observe. We have our fair value gap entry for the thank God it's Friday. We have also another one, which would be the yellow one. You can see it right above it, which we could have entered as well. Then we have our silver bullet entry, which is also where ICT has entered. And then we have the price movement going lower and lower, stopping between the 20 and the 30%. Here I highlighted for you the ICT entry and ICT exit, which you can see with the green and bluette circles. Guys, let's remember that Thank God It's Friday is day specific model and appears only on Fridays. What we can do to look at the setup of the Thank God It's Friday is, number 1, understand the price movements on a higher time frame. Number 2, understanding PD arrays. Number 3, analyzing the weekly move of the market and understanding the strength of the candles. Number 3, applying the power of 3 to the weekly moves. Number 4, applying the power of 3 to the weekly moves. Number 5, waiting for the price to form the high or the low of that week on Fridays, usually in the morning, otherwise between 12 and 2 New York local time. Number 6, applying the Fibonacci and finding our target range, which is going to be between 20 and 30%. Number 7, applying our ICT model and the confluences in order for us to enter the trade, placing our stop loss and our take profit. Number 8, taking the profits and enjoying our weekend. Let me know in the comments below if you have enjoyed actually these episodes. And guys, remember, this is the way. Keep going, do not give up. Positive thoughts, positive actions, positive life.